Hello, and welcome to the product demonstration of MakeMyFund, a platform that enables you to create your own personalized investment funds and express your mandates and not use only one size fits all mutual funds are there. We are here to replace mutual funds. I'm Swapnil Pawar, the founder of ASQI Advisors, the company behind MakeMyFund. Let's build some funds for ourselves. There are four ways in which we expect or enable investors to build their own funds. Highest returns, which is smart beta factor portfolios. My ethics, which is based on ESG and other such considerations beyond returns. My themes, which is for specific ideas in how to go about investing your money, whether it's sectors or multiple sectors combined together. And my goals, which is for say things such as retirement or children's education and so on. Let's see one in some depth. So when it comes to highest returns portfolio, we are combining a few smart beta factors like quality, value, dividend yield, and so on. Uh, the platform enables investors to choose the factors they believe in. The ones they don't believe in, they can exclude, reduce weight, and so on. And something we're particularly proud of is the universe selection. So you can select not only the top 200 versus mid cap versus large cap and the portfolio size, but you can also be very specific about companies, sectors, and business houses which are excluded from your universe. Let's see how. You may want to exclude a sector because you already have a lot of exposure to it, or because you don't believe in its future prospects. Here, I've excluded IT sector, for example. Or you can exclude a specific service, such as say realty or hospitality. You can even allocate less to a specific industry, saying it's not going to be particularly lucrative, but I don't want to exclude it fully. You can exclude business houses. I have excluded Thapar, for example, uh, or Ansels, let's say. Companies, again, you may exclude because you have stocks from that company on account of its your employment with it, or you don't believe that the company has a lot of future prospects. So this sort of exclusion allows you to essentially create your customized indices, and then the smart beta tails allow you to perform better than those indices as well. Now that we selected our universe, we see how this selection of factors and universe would have done in history. Uh, so our quant hedge fund experience allows us to simulate on the fly very easily over as many as 15, 16 years. So we see here 2007 till now, this portfolio has done 15.1% per annum versus a benchmark of 12.3% per annum. A good 3 percentage points outperformance. And as we talked about earlier, another 3% comes from tax and cost savings. So you could essentially be performing almost 5, 6 percentage points better than a typical benchmark. And these days, even mutual funds are close to benchmarks. So you could outperform your mutual fund by almost 5 percentage points. Year on year returns tell you whether this is a fluke or it was consistently superior. And performance metrics give you a sense of how it was in 1 year, 3 year, and so on. Now, the next thing is to see what would this portfolio look like today if I were to invest in it. And so this is the list of stocks. So this is one step away from execution, and we'll see how. And this is the industries that one is exposed to within this portfolio. As you can see, there is no IT here because we explicitly took it out. Now, you can further iterate here about the selection of industries, the universe size, and so on. Or you can simply say, this is acceptable to me, I like it. So let's move on to the next step. The next step is to name your portfolio and specify how much money is going to be invested in it. So I call it temp 234. The amount of money specifies what is the sort of stock level allocation you're going to get, because 2.3% doesn't have any investable implication. We have to say Castrol India 35 stocks and iShare 12 and so on. So this number goes towards creating that. So we are making it very real this point on. The rubber is hitting the road, if you will. So when you do that, you get this option. You get this option to actually execute, to go to your broker interface. So I'm not sure if the video will show that, but what I'm seeing right now is a pop-up which shows me 10 brokers to choose from: Zerodha, HDFC Securities, Edelweiss, IFL, 5paisa, and so on. And I click on any one of them, it takes me to the broker interface to execute the trades I just selected. So that's 1 lakh rupees being invested in what 45 odd stocks, and this execution will be live, and the money will be really invested with the stock sitting in my demat account. So in this case, this is a demo portfolio. I didn't execute it, so I can go to the dashboard and see. This case, for example, this was a paper portfolio. If I had invested, this would have become a live portfolio. All my portfolios are here. I've built 3 so far, let's say, and based on the portfolio's construction, I get my list of stocks as well as my returns over a period of time. In this case, these are all fairly new portfolios. That's one full sequence from starting with the highest returns mandate all the way to execution, and actually seeing the portfolio on the dashboard. Now, other things you can do obviously are my ethics, my themes, and my goals. My ethics allows you to do environmental, social, governance differently. The whole ESG being put together is a bit contrived in our view. So you can actually say, I don't care as much about governance, and environment is very important to me. We have added other non-returns considerations or ethical considerations like patriotic, which is essentially cap goods and defense, health focused, which is staying away from fast foods, polluting industries, closer to more healthy living, and so on. Now, there is also portfolios with or strategies with religious considerations such as Sharia, and we've created a Hindu equivalent of it called Satvik. So, Sharia is staying away from tobacco, alcohol, banks, and other interest earning companies. Satvik we have created, which is our proprietary idea, where you stay away from meat processing companies, alcohol, tobacco, leather, and other such unethical industries considered in some subsets of Hindu investors. Now, you don't have to take our word for what we call environmentally useful or what we call social impact company. You can choose to alter the weights of these sectors. So -1 here means no allocation, 0 means no variation from the benchmark weight, +1 means doubling of benchmark weight. So we list out here all the variations. If there is no the sector is not listed here, that means it didn't have any variation on account of that specific factor. And when you go next, essentially it takes you to the same portfolio building and returns evaluation. So you can again check uh, what's the performance. In this case, 14.2% vis-a-vis 12.3, which means ethical investing isn't all that unremunerative after all. You can further modify the universe as we saw earlier, even within the ethical considerations subset. And here on the execution is similar. In themes, we see two ways in which people may want to express their views. One is a ready-made theme, where a specific theme like discretionary consumption covers a set of sectors which benefit from increasing consumption in the country, economy, or say rural India or export-oriented sectors. We'll keep adding to this list in future, such as divestment beneficiaries or EVs and so on. Think of it as essentially ETFs as they are in the Western world, but not sector ETFs, more thematic ETFs. When it comes to sector views, again, there are not too many good ETFs out there beyond a few obvious names like FMCG or BFSI and so on. And there also you have to rely on the manager's assessment of what the sector includes. So we allow you to specifically choose sectors, subsectors, create your own ETFs effectively at all levels, which can even have multiple sectors or industries and their various allocations. When it comes to goals, the obvious most common goals are essentially retirement and children's education and marriage. We also added house purchase, foreign travel, etc. for less savvy customers who just want to build towards a goal, don't care about alphas and betas. Now, a unique concept that we have propounded is personal inflation rate. If you're saving for your retirement, it doesn't mean that you have to assume that inflation will grow at 5%. It could be 3% or 12%, depending on what you spend the most on. If it's education, then it's very high. If it's only utilities, then it probably is low. So, depending on what is your exposure to the consumption basket, you can actually vary it and see what sort of sectors that you should invest in for that portfolio, uh, which will hold you in good stead, hedge your risk of that specific sector's costs running away rapidly. You can also do the same thing for children's education. For example, if you're saving for children's education, which has a foreign studies component, then it's important for you to hedge the USD INR risk. And so we do that by virtue of adding NASDAQ in the portfolio. For a domestic one, you don't need that. You need exposure to services sectors and hospitality and education sector and so on. So that's children's education. For children's marriage, we also have gold ETFs in the portfolio and so on. So that's about building a portfolio. Then the next question is, how should I invest in equities? Is it SIPs alone? We think that the SIP orthodoxy is overdone. So for lump sum investments, people rarely take the plunge one at a time, nor do they do systematic transfer plans. So it's good to say invest in five equal tranches, but nobody does that. So how do we tide over that? So this helps one solve that. So let's say if you want to invest 5 lakh, say 2,50,000 rupees over some horizon, and you want to build a market entry program. So we create this program for each individual, saying, given today's market scenario, you can make the first tranche investment right away, which is a small subset, about 1/7 of the total. But the next investment is not just a systematic transfer plan that every 1 month you do something. It's essentially is based on market levels. So if markets go up sharply, then you don't invest. If the markets go down, then you invest in the dip, and so on. So that allows people to construct a program of investing in their constructed uh, portfolios, or e-funds as we call them, and at the same time not be afraid that I'll miss out on the rally, or I'll not invest when markets are dipping. And we keep track of all of that, and we trigger the investments at one click by from the investor side. So that, in a nutshell, is Make My Fund, and we invite you to try it out, give us your feedback, and I will keep making the site richer and richer as we go along. Would love to hear feedback about this and its various features. Thank you so much.